As we get into the mid-session on the grain markets, let's bring in Brian Hoops. He is the president of the Midwest Market Solutions based out of Springfield, Missouri. And Brian, as we take a look at our markets, we'll go ahead and take a look here at the corn and soybean trade, and then I want to get your thoughts on a few things. On the corn market right now, we are still lower on the day. We kind of elevated off of the lows, about a half hour into the trade, and then started sagging again. Now we have the September corn down 13.5 at 371 3/4, and December now down 12 again at 380 3/4. Still a couple of pennies off of our earlier low, but it's kind of holding down there with quite a bit of weight. On the soybean trade, though, it has been going the other direction this morning. September soybeans still 11 1/4 higher. We're at 878, 15 cents off our earlier low. And November now 11 1/2 higher at 890 3/4. So that's the latest on the soybean trade. And then if you look at the wheat, in Chicago we're higher. We have it 5 1/2 higher on September at 477 1/4. On the Kansas City market today, it's kind of dragging its feet. We have it down 3 at 389 1/4 on September. And Minneapolis wheat is currently trading a little softer. We're down 3 3/4 at 505 3/4. Interesting to note, Brian, of course, the market is digesting all the data that came out from USDA yesterday. Just a quick comment from you on what you thought of the overall acreage numbers and then that increase in the corn yields, too.
I think the increase in the corn yields was probably the most surprising to me from just talking with producers. USDA did drop yields from their trend line at 176 down to 166 in the June report. But to jump at 3.5 bushels an acre here just a couple months later, even though conditions have stabilized, I don't know that they improved that much. And that's what I think caught a lot of people off guard. But, the fact that a lot of people are not talking about in the soybean market is they lowered yields, planted acres in soybeans by 11.5 million from a year ago. And yet our ending stocks have only changed marginally. We are still looking at the second largest ending stocks in history for soybeans, and that's a sign of how poor our demand has been for exports and for crush for soybean meal. So, it had a lot of bearish implications in yesterday's reports. Whether you believe the yield numbers or the planted acreage numbers, I guess, is subject we'll find out as time goes on, and may have to get into actual harvest data before we have a better handle on how good or how bad some of this corn and soybean crops are, because we're still a long ways away from seeing any type of a maturity on either one of those crops.
I was doing some digging into the data this morning, and based on the crop progress and condition report yesterday, the states that are the furthest behind in corn silking would be Michigan. They have 35% of the crop still hasn't silked yet as of Sunday. Ohio, 29% hasn't silked as of Sunday. Wisconsin, 28%, and Indiana, 21% of the crop still hasn't even pollinated yet. And if you figure 60 days from now, Brian, that puts us well into October, if not the last half of October or beyond, to get that crop mature out there. And first frost dates in most areas are at least early in October, if not in September in those areas. That's a little problematic.
Yeah, it certainly could be, unless we have that really late harvest that everybody is hoping for, very late frost date. We're just going to have to extend this growing season. A lot of people are very concerned about that, and there's still, some time to see the crop get hurt here and see some sort of a rally. I think one thing that that's going to work against us on a rally in corn is the funds are still holding some big, large net long positions. Large specs are over 220,000 contracts net long in corn, and they are liquidating. You can see we had a rally off of our lows early this morning into the morning hours following soybeans higher, but that rally was beat back down as funds continue to try and liquidate long positions. But in the soybean market, funds are already short about 25,000 contracts. We're seeing higher prices today, and if we get the right conditions, namely an agreement with China or extending the tariffs deadline like we did this morning, you can see we could have a pretty sharp rally in the soybean market because these funds are holding net short positions.
Excellent points. All right, hold that thought. We'll come back and talk livestock with Brian Hoops in just a moment. Don't go anywhere. We're talking with Brian Hoops of Midwest Market Solutions right now. Time to talk livestock. And as we look at our live cattle board, we're lower, and boy, are we lower. We are expanded limit lower on the first 3 contract months now. So that means we're down $4.50. That puts October at 99.25. We have December down $4.50 at 103.95. The deferreds are trading sharply lower in the upper $3 range to the downside. Now, if you take a look at the feeder cattle market, here on the feeders, we'll go ahead and start with September. We're down $3.85 at 130.10, and October down $3.15 at 130.60. So we're only about half of what the expanded limit move could be today. Let's take a look at the lean hog market. Lean hogs were sharply higher in the open on the October contract, but now that's turned around. And October now at 65.83 is down $1.25, and the deferreds are higher. December is 68 higher at 64.45. Thoughts on the livestock trade here? I know everybody's talking about the Tyson beef plant fire around Garden City, Kansas there. But is there more to this as far as why the heavy selling on the cattle?
Well, yeah, we are seeing a very heavy selling the front 3 months, as you mentioned, limit down right now, even if we have expanded limits. They did bounce around and gave people a chance to liquidate some of those positions if they were inclined to. But you know, that Tyson plant being closed is the main culprit. It's certainly going to hurt the cash markets, and this could be, you know, a 6 to 8 week type of closure where the cash could be under some pressure because we don't have that slaughter facility open. I think it will create some opportunities into some of those very deferred months. They should get hugely discounted, and we'll start to see some buying interest there. But, you know, a point that you brought up off air, pasture conditions declining in parts of Texas. A lot of those cattle could come off of grass and go into feedlots, but boy, these feedlots are already packed full in the Southern Plains, Kansas and Texas. Feedlots really don't have any room to put these cattle, and we just don't have the slaughter capacity right now to handle it. So they're going to try and redirect some of these cattle, but I think it's going to take some time before we see a cash market that stabilizes.
Brian, thanks for the outlook at the markets here today. I appreciate the help. Brian Hoops of Midwest Market Solutions. He's in Springfield, Missouri. So, Christina, that's the status quo as we are right now.
Well, at least some of the markets are turning around. We'll see what happens as the day continues.
Yep.
Yeah, thanks, Marlon.